connecting investors, financial institutions, and businesses around the world. Luxembourg is a center of excellence for global finance. Recognized for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial center and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning, ladies and gentlemen. I am Benoit, Theunissen, Policy and Regulatory Affairs Advisor with Luxembourg for Finance. It's a pleasure to welcome you to our online event focused on EU regulatory agenda. Over the next hour, we will delve into the intricate and dynamic landscape of financial regulation within the European Union. Our event today serves as a platform to bring together leading experts to help us navigate the complexities of the EU regulatory agenda, from capital markets to market integration, to financial crime, sustainability, and digital finance. Our agenda today reflects the EU commitment to ensuring stability, innovation, and integrity within its financial markets. We have an exciting lineup of speakers and discussions today. First, we will have an introductory keynote address titled Trajectories in EU Financial Policy by Alexandra Jour-Schroeder, who is Deputy Director General at DG Fisma from the European Commission. Next, I will have the honor to interview Guilbert, partner at Norton Fulbright, Luxembourg, in a fireside chat entitled CMU from Fragmentation to Integration with Private Markets. Following this, Dr. Stanislaw Tosza, who is Associate Professor in Compliance and Law Enforcement at the Faculty of Law, Economics and Finance at the University of Luxembourg, will present a keynote address on AML Reimagined. He will be discussing the new anti-money laundering regulatory architecture in the EU. Then we will hear from Dr. Markus Lange, who is partner at Baker Tilly, who will give a keynote on ESG, from regulation to market practice. Finally, our event will conclude with a fireside chat on open finance. We will explore how the fintech ecosystem has benefited from PSD2 and will build upon the upcoming FIDA. For this session, Josy Soussan, who is in charge of European policy and government relations at Klarna, will be interviewed by Alex Panican, Deputy CEO at the LHoFT, the Luxembourg House of Financial Technology. I hope you will enjoy these talks and discussions and gather valuable insights. Thank you for joining us and have a great event. I give now the floor to Alexandra Jour-Schroeder, Deputy Director General of DG Fisma, for her keynote Trajectories in Financial Policy. Alexandra, the floor is yours.
Benoit, thank you very much for the kind introduction and very good morning, ladies and gentlemen. Thank you very much for the opportunity to kick off today's digital conference, timely organized by Luxembourg for Finance. We're actually a bit more than 2 weeks away from the elections for a new European Parliament that is crucial in shaping the future of European democracy and of our Europe of tomorrow. In an increasingly complex and interconnected world, the European Union needs to be prepared to address global challenges that no EU country can tackle successfully on its own. With new actors gaining influence at global scale, our financial sector can bring a fundamental contribution, unlocking the great potential that lies in EU businesses and citizens. To do so, our EU agenda for financial services needs to be grounded in financial stability, investor protection, and competitiveness alike. Today, I would like to start to focus on some specific trajectories in EU financial policy we consider vital for financial services stability, growth, and innovation. Let me start with the twin transition in finance. Among the key global forces pivotal in influencing the economy of the future are the growth of digital technologies and sustainability. Since 2018, and in particular during the current European Commission mandate, we have therefore put a strong focus on our digital finance and our sustainable finance strategies. On the ESG side, the European Union has been the front runner globally in shaping an ambitious regulatory agenda to facilitate the flow of funds into a more sustainable economy. At the same time, we have taken action to manage the risks that climate change and also environmental degradation may pose to the financial sector and the economy at large. Our comprehensive EU Sustainable Finance Toolkit now provides for setting transition strategies, structural financial transactions, and reporting on sustainability efforts. I have to say that in the past 6 years, considerable progress has been made. Our indications now show that our sustainable finance framework is gaining traction, with market actors embracing the opportunities it offers. The EU taxonomy is evolving into a widely accepted market practice and a tool for companies to set targets. And on the disclosure side, we have now a framework that includes both disclosure of sustainability information of the financial sector, but also of large companies. Let's not forget that the EU is the first jurisdiction to place financial reporting and sustainable reporting on an equal footing. And now that the regulatory framework is in place, our focus is, and it must be, on its practical implementation. Indeed, as I said, the regulatory framework is comprehensive and it is also detailed. What I can say today is that we will continue in our efforts to provide guidance how industry can use the tools in the framework to make it fully usable. We are, for example, looking into the Sustainable Finance Disclosure Regulation, one of the first legislative acts that were adopted, and there is a lot of interest in this. We have, for example, received more than 400 responses to our public consultation. We are now carefully examining. We will also further examine whether and how we can facilitate sustainability reporting in line with the Commission's goal to reduce reporting burden by 25%. However, without losing sight of our goal to address the challenges of climate change. Ladies and gentlemen, technological developments such as digitalization and automation play a major role and may reshape entire industries and sectors. There are leaps in enabling technologies such as distributed ledgers technology, DLT, encryption, analytics of big data sets, and not to forget artificial intelligence. The rise of digital assets and novel form of financial intermediation very much influences the international financial system. In the EU, again, we have made very good progress to exploit the opportunities of digitalization. We are focusing a great deal of attention on the new wave of technological innovation, including fintech, which impacts actually on all aspects of financial services. including payments, lending, insurance, and investments. Over the last years, we have built, inter alia, a cross-border framework for digital identities. We have established also as the first jurisdiction a regulatory framework for markets in crypto assets. We are determined to tackle new risks associated with the digital transformation. We are working hard to implement the Digital Operational Resilience Act with all the necessary technical standards to be in time for its entry into application as of 2025. And as you will know, we have also embarked in the discussion on the Commission's proposal for a digital euro. Open finance, we will also discuss today, is another important initiative the European Commission presented in 2023 in view to facilitate the sharing of certain customer data, aiming at providing a wide range of financial and information services. We believe that this extension of the open banking concept, first implemented in the payments area and for bank accounts with PSD2, will bring important benefits, while at the same time allow customers to retain control on their data. The second important trajectory, CMU, I would like to speak about today. Capital market creations, having a better integrated and better developed EU capital market is certainly a top priority for the European Commission. Of course, this is not to say that CMU is a new idea. We have actually adopted a vast area of measures over the years. Among them are initiatives which bring important incentives for firms to use market funding and of investors to fund them. And again, let me give you a few concrete examples. The new European Single Access Point, the ESAP, once in place, will be an important public data source for company and product data. The new European Consolidated Tape is a real game changer for real-time trading data. And the Listing Act that was recently adopted paves the way for easier access for companies to public capital markets. I'm also very pleased, I have to say, with the recent progress we have made to improve withholding tax procedures. They will present us a very significant simplification. And these measures, and there have been many others of the CMU 2020 action plan, are expected to have a significant positive impact on the development of EU capital markets. It will take some time to work through to the markets and change the way they operate today. However, it is also clear that we are still not where we want to be in terms of market development and market integration. The EU continues to be predominantly bank financed. Few growth stars have unfortunately emerged. The EU capital market remains still fragmented, and too many companies are leaving Europe to the United States. So it is evident that the EU needs much more developed and integrated capital markets to reach its key strategic goals over the coming years. The good news is that political support for CMU has been strongly increasing recently, including from the highest political level by the heads of state and governments in April this year. I can tell you today that on the Commission side, we are determined to fully use our role as motor of EU integration to design measures for a CMU that acts as a driver for wealth and growth across the economy. Before entering the next political cycle with a new European Parliament and a new Commission, it is a bit early today to provide you with concrete initiatives. However, I can assure you that we are analyzing intensively various ideas we receive from public and private stakeholders, including the recommendations from the recent very interesting report of Enrico Letta. It is encouraging to see that there is quite some convergence appearing with regards to the area in which we need to make further progress. These include, for example, measures to revitalize the securitization market in the EU. On the other hand, it is also clear that there are areas where views are expected to differ how far we may or we should go. We look forward to getting feedback and support of all stakeholders, and I'm very sure we can count on your contributions as well. Lastly, as anti-money laundering is also part of your program today, I would like to take the opportunity to make a few comments on the legislative package that has recently been agreed by the European Parliament and the member states. I want to do that because I'm convinced that the new regulatory regime will change the Union's regulatory and institutional setup. It is not merely a reform. It is a tectonic shift in the Union's preventive framework. We have now a truly harmonized rulebook, allowing, for example, the financial sector, the Union gatekeepers, to follow the same rules and adhere to the same standards wherever they are in the European Union. I'm also very pleased and happy that we could address the valid concern of information sharing between private and public actors. And last but not least, the new authority, AMLA, will create a single system of supervision and a good support for Union's financial intelligence units. Of course, it will not act in isolation, but closely with the national competent authorities. So, ladies and gentlemen, let me conclude. The European Union has all the potential to serve as a perfect hub for growth and jobs, a competitive place where innovation happens and future regional and global champions emerge. And in all this, the financial sector has an imperative role to fully exploit this very strong potential. We need a tailor-made financial regulatory strategy that is fit for the future. One of its elements must be to make full use of our single market. Single market will help us to overcome fragmentation and to fully use the opportunities of its scale. I'm looking forward for today's discussion, which will certainly bring us excellent input for the EU regulatory agenda for our next political cycle. Thank you very much for your attention. And with that, I give the floor back to Benoit. Thank you.
Thank you, Alexandra, for this very insightful keynote on European future trajectories in financial policy. I am now with Claire Guilbert to deal with how the Capital Market Union, also called the CMU, which is currently under construction, will harmonize the European fragmented capital market and also unleash the power of private markets. Claire, good morning and welcome with us this morning.
Hello, thank you for having me.
Thanks. Claire, you are a partner at Norton Fulbright in Luxembourg. In this role, you advise local and international asset managers in the structuring, formation, marketing and organization of regulated and unregulated investment funds, with a particular focus on alternative strategies.
Exactly.
So to start this fireside chat, Claire, I would like to have your opinion. How was the initial draft of the plan to create the CMU, particularly with the first iteration of LHoFT? How did it influence the integration of private market, in other words, the financing of SMEs and the reinforcement of the venture capital ecosystem?
Well, so FMD was introduced in 2011 and then was implemented into local law of member states in 2013. And FMD really harmonized the rules on managers of alternative investment funds, meaning those funds investing in illiquid assets. And so that's really the heart of private markets we are talking about today. AFMD was a direct response to the financial crisis of 2008 and was really focused on investor protection, focused on making sure that managers of those funds, managing those assets, which are illiquid, which are long-term, apply an harmonized set of rules that protect ultimate investors. But AFMD is really targeting professional investors in particular, creating a European passport to sell those funds to professional investors. The CMU plan, so Capital Market Union Plan, was introduced in 2015, so a couple of years later, by the Juncker Commission. And here, really, the plan was, the CMU is really, I think, the kind of next level, next step following AFMD to enhance the investments into Europe. So both facilitating access to those investments, but then also making sure that there is sufficient funding opportunities for SMEs and especially startup companies. And so that's a very good first step for the capital markets in Europe. And the CMU was composed initially of several actions that actually created certain key regulations we are living with today around securitization activity, solvency rules, and then also European fund labels that are addressed also to retail investors and not only to professional investors.
Okay. It turns out that the European Commission redefined its vision of the European CMU in 2020, yes, with the development of a new action plan. I would like to know, does this represent a radical shift in angle and approach, or also a new paradigm?
Well, yes. So the CMU plan of 2015 was a good start, but didn't really enable a full development of the European capital markets because they remained very fragmented in practice concretely. Why is that? It's because, again, the background of investor protection. And so it has always been a challenge to protect investors and at the same time boost investments, especially in an illiquid world where the risks are higher. And so the labels that were created in 2015 with the first CMU plan, for example, were based on a very good idea to create a European passport for retail, but at the same time wanted to protect investors by restrictive measures. And so those fund labels were accessible only under certain conditions, certain restrictions applicable to those funds, which unfortunately didn't match with the philosophy of the asset class underlying. And so ultimately it was very difficult for managers to comply with those rules, and the labels were not really successful at the end. And so the CMU plan of 2020, I think, has a different angle, tried to shift indeed from protection by restriction to protection by transparency. And we see in the new actions of the CMU plan of 2020 various measures that enhance protection by disclosures, by transparency, by actions that are not necessarily restrictive, but that put more burden on all the actors to be involved in the protection. And I think it's a good thing. Also to keep in mind that CMU 2020 has different objectives, being also to promote green and sustainable finance, to evolve alongside the digitalization of the finance industry, and also is a response to the COVID crisis to make sure that the economy recovery is on its way. So there is a lot of different initiatives around that new plan that we need absolutely to promote. And this is also in line with the retail investment strategy that is one of the actions of the new CMU Plan 2020.
Yeah, you speak about retailization. I guess that this new plan from 2020 is one of the goals is to reach the retail investor. Is that in that trend that integrates the LHoFT 2.0, for instance?
Definitely. Absolutely. So, you know, as I said, LHoFT 1 was an action of CMU 2015. LHoFT 2 is an action of CMU 2020. And as I mentioned, in the label, and especially in the LHoFT label, which is a label that targets long-term investment funds, so in various different real economy asset classes, so really with the aim to put money into SMEs in Europe, but also more broadly speaking, and to make sure that those vehicles are available to retail so that it's an alternative saving mean for retail investors in a world where the traditional savings opportunities for everyone are quite limited. So it's kind of a win-win. And the new LHoFT, so LHoFT 2.0, kind of takes into account the two restrictive measures that were in the first version, unblock those, but also try to adapt the product to the actual underlying assets. So there are different changes in the regime that are very welcome by the industry.
Okay, and what about AFMD2 in that sense? Is it somehow related, or how does it integrate in this new strategy trends, your approach?
All regulations are interconnected, definitely. AFMD2 targets initially professional investors, right? But the European labels like LHoFT are covered by AFMD2 because an LHoFT is an AIF, an alternative investment fund, and so that vehicle is subject to, or that the manager of that vehicle is subject to FMD. So definitely FMD2 changes are aligned also with the changes we see at EU fund labels and also within the retail investment strategy. What we see in FMD2, and also knowing that there are also changes in MiFID, for example, or in the UCITS directive, is that we are trying to harmonize and facilitate access to the professional client qualification classification, so that an investor could more easily be qualified as professional client and access AIF's product under AFMD, so that we broaden also the access. Because ultimately, for a lot of managers, they're not all targeting retail investors, meaning you and me. They are targeting sophisticated investors, right? But those sophisticated investors may still not be up to the standards of a professional client under MiFID as is currently defined. And this has to be addressed because we are evolving. Because now you see a high net worth individual is very sophisticated. Family offices, they spend their days investing in those products. If you look at the rules of the professional client definition, it's currently quite difficult to actually meet all the criteria. Although technically, in practice, we would say those investors are professional enough, are sophisticated enough. And so it's very good to see that the legislation is evolving also with the mentalities.
I see. And I would like to conclude with the last question with a very commonly held idea. Maybe you might disagree, but it's commonly said that European private markets are less developed or far away from those in the United States. Maybe you might disagree with that and you might have a different view. Maybe the approach might be different, investment risk culture. What's your views on that?
Well, yes. I mean, I see it with managers and what they do in the US compared to what they do in Europe. Definitely, I think it's a question of mentality. In the US, they have a different approach to investments, to risks, than we have in Europe, where we are much more protectionist by culture, right? We are trying to remain protectionist, but have a different approach to the risks and to investments, as I mentioned before. And that's a great thing, I believe. And that is probably going to kind of make us evolve into the same direction as the US, while still keeping a certain level of protection through regulations, which I believe personally is necessary. And we see it, we are happy with it in time of crisis.
Okay, so you don't only see obstacles, but also room for improvement.
There are definitely, and it's good to see that there is a dialogue with the European legislature about the room for improvement. Currently, we have this retail investment strategy, and despite its name, it's actually a strategy that tackles a lot of different regulations in Europe with the aim to boost the investments in Europe, right? And access to the investment and access to financing, and especially alternative financing. As part of the measures, when it comes to product open to retail investors, definitely there will be certain measures that will be a burden from a manager perspective, from a distributor perspective. And we need to make sure that those measures take into account the needs of all actors. Because if we open a product to retail, but then create too much burden on the person managing that product or distributing that product, they will not want to manage or to distribute that product anymore. And so that's a risk where we need to make sure we balance the interests of all parties correctly, and it's a very complicated game. And I'm curious to see now the trilogue on the retail investment strategy, and to see where it will be heading.
Indeed, the future will be very interesting.
Yes.
Thank you very, very much, Claire, for this very enlightening insight.
My pleasure.
I give now the floor to Dr. Stanislaw Tosza, who will speak about the new and upcoming anti-money laundering framework at the European Union level. Stanislaw, the floor is yours.
Thank you very much, Benoit. Good morning to everybody. The anti-money laundering framework is about to undergo a significant reconstruction, although some aspects that do seem revolutionary might not be so dramatic as they seem. Other features of the reform, however, while being overlooked at present, may turn out to be truly groundbreaking. As we speak, the EU Parliament has just adopted the AML reform, and it is now only awaiting the vote of the Council of the European Union and the publication in the official journal. What are the main premises of this reform? The AML framework is composed of a repressive component and a preventive component. As to the repressive component, which is provided by the AML Criminal Law Directive, it will in principle remain intact, except for a small amendment with significant consequences, to which I will come back later in my speech. The main overhaul the reform does to the preventive component. It is now composed of the 4th AML Directive in the version amended by the 5th AML Directive. The 4th AML Directive provides for the duties of obliged entities, in particular the Know Your Customer obligations and duties to monitor and report the suspicious transactions. It also sets up an institutional supervisory system. This AML framework was subject to criticism for a number of reasons, mainly due to the ineffectiveness of cooperation and coordination between national supervisors and financial intelligence units in tackling cross-border financial crimes. Furthermore, proliferation of crypto assets proved to be a challenge for this framework. Despite amendments made by the 5th AML Directive, not all possible scenarios of involvement of such assets were covered. These reasons led the EU Commission to propose in 2021 the reform package of new legal instruments, which is now being adopted. The new AML preventive framework will be composed of 3 elements: an AML regulation containing the compliance duties of obliged entities, and the AML directive providing the supervision framework. These 2 instruments shall start to have effect in 3 years from now. The framework will also be enhanced institutionally, and that is the 3rd element, with the establishment of the Authority for Anti-Money Laundering and Countering the Financing of Terrorism, the AMLA, which will be placed in Frankfurt. AMLA should assume most of its tasks and power in accordance with the AMLA regulation by mid-2025, and direct supervision of selected obliged entities should commence as of 2028. The main modification introduced in this new framework is the change of the legal instrument to a regulation, which comes after a succession of 5 directives. The Commission explains this choice by the lack of directly applicable rules and due to the differing interpretations of the directives, which resulted in a fragmented approach to regulation and supervision along national lines, contrary to the requirements of an integrated internal market. A directly applicable set of rules at EU level is also needed in order to allow direct EU-level supervision by AMLA. Otherwise, direct supervision should be hampered by the need for AMLA to apply 27 differing national legislations comparable to the situation of the ECB within the single supervisory mechanism, which is prone to complexity and inconsistency. The adoption of a regulation means that the rules will be directly applicable and member states will not have discretion, even if limited, while implementing them. As to the content of the AML regulation and its philosophy, the difference is not revolutionary in comparison to the 4th and 5th AML directives. The rules on due diligence, reporting duties, penalties for non-compliance stay in place. Some rules become more detailed, such as the scope of identity details that must be collected for customer identification purposes, the information that must be obtained to verify the purpose of business relationships, the definition of beneficial ownership, and the reporting arrangements for discrepancies in beneficial ownership information, including exemptions thereto. The regulation will be accompanied by the AML directive, mainly governing the organization of the institutional AML system at national level. The directive strengthens supervision by clarifying the tasks and powers of supervisors to ensure that they all have the instruments to take adequate remedial actions, and by establishing colleges of supervisors and mechanisms to improve supervisory cooperation in relation to institutions operating across borders. It also enhances the cooperation between FIUs by clarifying their tasks and powers and laying down a framework for joint analysis of suspicious transactions or activities linked to different jurisdictions. On top of this framework, AMLA will be responsible for overseeing and coordinating the work of national supervisors and FIUs, and it will assume direct supervisory competence over a limited number of credit and financial institutions with high cross-border activities and a high money laundering, terrorism financing risk profile. As said, these changes are not revolutionary per se. What is a more significant change is the inclusion of enforcement of international sanctions, known in EU law as restrictive measures, to the AML framework. The compliance with international sanctions is already part of the duties of the financial sector and has been incorporated into its practices. However, the new system will significantly extend those duties in a manner that will create some substantial burden and risk for the financial institutions. In order to perceive the change and its impact, we need to analyze together several instruments. The EU has just adopted a directive that harmonizes definitions and sanctions for violations of EU restrictive measures. It obliged the EU member states to assure that different courses of conduct constituting such violations must be punished as criminal offenses in national legal systems. This directive contains a small amendment to the AML criminal law directive, and it is this small amendment which, as I already signaled, proves to be revolutionary. This amendment namely adds violations of EU restrictive measures to the list of predicate offences in the definition of money laundering for the purposes of the AML criminal law directive. It would remain without impact for the preventive component of the AML, except that the new AML regulation ends with a terminological dichotomy of different definitions of money laundering for the purposes of prevention and repression. From the entering into force of the new AML regulation, there will be only one such definition for both components, and it will be the one from the AML criminal law directive. In result, the violation of restrictive measures will become predicate offences of money laundering for sake of the preventive side of AML. Hence, from entering into force of the AML regulation, the obliged entities will have to monitor their assets and verify their clients from the perspective of the risk of laundering assets that somehow proceed from circumvention of the restrictive measures as described in the Restrictive Measures Directive. Moreover, the AML regulation contains a number of duties which directly refer to the enforcement of international sanctions as such, even if in theory this has nothing to do with combating money laundering. While the inspiration for including those duties seems to come from the FATF guidelines, the latter were linked to proliferation financing, while the AML regulation does not contain this limitation and the duties concern any type of international sanctions. The careful reading of the AML regulation in view of all these aspects leads to a conclusion that once it starts applying, we will be able to speak of three pillars of the AML system: combating money laundering, combating financing of terrorism, and enforcement of international sanctions, also known as restrictive measures. You may already notice the lack of terminological coordination between the AML reform and the Directive on Restrictive Measures, and the use of terms restrictive measures in the latter directive and targeted financial sanctions in the AML regulation. But what is even more striking is the lack of proper debate on the impact of the extension of the AML framework into enforcement of international sanctions, which will be significant for the obliged entities and for their clients. While it is not my intention by any means to question the policy behind the sanctions, I'm wondering if the real impact of this framework will be felt in the economies of the countries subject to sanctions, as is the objective of those measures, or rather in the EU economy with substantial everyday compliance burdens with significant costs but limited results. Finally, assets that are subject to sanctions may be blocked for different reasons, but per se they do not constitute benefits from criminal activity, such as drug trafficking, which has been the reason for combating money laundering all along. This new AML system seems to venture here into new territories, the consequences and limits of which we can at this point only imagine. Thank you very much for your attention, and now over to Markus.
Many thanks, Stanislaw. Many thanks for inviting me to talk here about ESG matters, one of my favorite topics, of course, and always a pleasure to be together with you, the Luxembourg community, talking from the place of the EMLA to the place of LHoFT and many other interesting things. And I'm always impressed, let me just say, about the agility and flexibility of the Luxembourg financial place and its actors. Yeah, this morning we got about 10 minutes for sustainability. Usually I shouldn't be able to do that. Of course, I'm so honored to speak here so that I'm going forward with that enormous challenge. So we need to speed up quickly. We need to have a speedy journey through the next about 10 minutes. And so please fasten your seatbelts and make yourselves comfortable. My brief intervention just goes with, so to say, an opening part with a few general remarks, introductory remarks, then I have a closing part, and I have a few topical issues regarding specific regulations in the middle, as we here talking about from regulations to market practices, and you could always or also take a question mark behind, because in particular in the sustainability area, I think it's not quite clear whether this is really acting on happening this way for various, in part, obvious reasons. So let's start right now. A few introductory remarks. What are the important milestones to date with respect to ESG regulation, the EU action plan? Some things have been mentioned before, including by Alexandra. But anyway, including the EU Action Plan Financing Sustainable Growth of March 2018, of course, then the Green Deal from the then new Commission, now December 2019, coming to an end now, the period of the Commission, of course, as you know, and then I think the Sustainable Finance Package of June 2023 included some interesting things and interesting hints towards the future of regulation. And talking about ESG, I always like to say, and please don't be too nervous or don't worry about it. ESG is not a regulatory invention. It has been an invention about 20 years ago, as to my knowledge, by asset managers for marketing purposes, just to label funds, make it more interesting in the asset management industry. More broadly, I would like to talk about sustainability. And of course, I think today we are quite sure that we need to talk about the real economy transition, net zero green transition. And as we know today, 5-6 years later, after the EU action plan just appeared, the second step has been taken before the first one, because the transition needs to take place within the real economy and financial service industry, as important as it is, of course, also in Luxembourg, can only be a facilitator, a lender, an insurer, an investor, and so on. That was my introduction, coming to 4 pieces of legislation, starting with the disclosure regulation SFDR, which has also been mentioned before, applicable as of March 2021 and January 2023. I think this was the first piece of the first more important piece from its ambition of regulation under the EU action plan. And question here in particular is, does it mean from regulations to market practices, or doesn't it really mean, if we are honest to ourselves, in a certain way, the continuation of ESG investing as it has been practiced before, and disclosure regulation SFDR being an attempt, of course, influenced by market actors when it came into force and came into existence, to make it in a way not too different from what we have been practicing before. But against the background of what I mentioned in the beginning, ESG investing is a good thing. It's about exclusion. It's about best in class. It's about ratings and making lists of criteria. The real economy transition, I think, has come to our attention in the meantime a bit more precise and a bit more in terms of this is what it's really all about these days. And taking this into account, I believe the discussion about Article 8, Article 9 funds and all these things need to be seen in that context. Requirements very detailed and complex, PAI tables, product templates. I don't know how well you managed to get along with that. I know a lot of people who were really worrying about it. And question then at the end of the day, what does it mean to an investor? What does it mean to the normal public to have information on that on the website and on pre-contractual information? I'm not quite sure. And the Commission also has been critical itself, interestingly, in its consultation in September last year. It came up, with a number of questions, including, do I need a certain classification for funds? We know Article 8 and 9 had just been disclosure requirements in addition to what needs to be disclosed anyway. And as we heard before, also again from Alexandra, Commission just has in a way reviewed all the responses and now is, I wouldn't say struggling from my point of view, now it has the hard task just to find a way forward. But this kind of disclosure approach, I'm not sure if this is really something that has influenced market practices yet. The other very important, so to say, beginning regulation under the action plan was the taxonomy, of course, which was meant as a major classification system for environmentally sustainable investments. But as always, I'm a lawyer, many of us are lawyers. In the Commission, there are lawyers. Rules have become very, very complex, even more complex possibly as under the SFDR, where it's a matter of attention to very, very detail. And here it has come along with the technical screening criteria and level 2 with the DNSH principle, minimum safeguards to be taken into account. And as we see, not only because I'm working together with auditors here, but possibly generally, I quite often come across the attitude that taxonomy regulation is mainly about certain reporting KPIs, exercise. What we know is generally meant as an addition to taxonomy the days when it came into force, January 2022 and 2023 respectively, the Article 8 rules plus the Article 8 delegated regulation. So we also need to see whether taxonomy is an example from regulation to market practices. I would still wait for it, and we need to see what's happening going on. Then very briefly, the third piece, MiFID. As I have been a kind of MiFID enthusiast in the past, just need to mention it, the sustainability preferences, August 2021, this came into existence and to be applied. A combination of things from SFDR and from taxonomy against the background of what I tried to very briefly show you and explain to you before, products still to be developed, investment opportunities still to be identified. So as to my awareness, the sustainability preferences within the suitability test has not proven to be the concept which really makes market practices work better, in particular towards transition financing. Moving on already to the last part of my brief regulatory overview. What can it only be? Reporting. Sustainability reporting now under CSRD and ESRS. On the one hand, I would say, the big promise to now address real economy, now to address the taxonomy, the transition related issues and bringing real economy enterprises towards being able to make their own transition respectively. Of course, it applies depending on, certain figures of how large a company is, also to financial service enterprises, but as I tried to mention before, they have a different exercise. They are facilitators, and so on and so on. So notice comes as of the beginning of this year, January 2024, for bigger companies which are of public interest. This is already for the current business year in operation. Other larger companies, but this only means, so to say, a balance sheet total of more than 25 million or turnover more than 50 and or more than 250 employees. The test is 2 out of these 3. They will be in the game next year, so they need to report at the latest beginning of 2026. And this now goes along with financial reporting, and quite importantly, financial reporting, as we all know, is generally about transparency. It's not about making an enterprise a reporting enterprise, just inducing it to be more profitable. Differently here, sustainability regulation and reporting, and as it was called before, non-financial reporting. Now it is called sustainability reporting, and it wants not only to provide transparency, but to induce and to make enterprises feel an ambition to become more sustainable. But again, this comes with many, many details. Level 2, the ESRS, the reporting standards, the new ones are directly applicable under a delegated regulation as of beginning of this year. More than about 300 pages, at least in German language, many, many details, many data points. It's about the core of the enterprise, its strategy, its business model, its value chains, even more than supply chains. So we will see what happens, but as it goes all under the double materiality perspective, inside out, outside in, it's a perspective of impacts, a perspective of risks, of financial risks. And we will see, and what is called the IRO evaluation, impacts, risks, and opportunities. I always tell my clients and hopefully prospective clients, let's also look at the opportunities. Let's look at your sustainable corporate governance, your corporate strategy. Looking at the time, I'm coming to my next point. I'm closing within the next minute. And thanks for your patience. What's happening currently and what's happening next? As we learned from Alexandra, and as you all know, as you're well aware of that, elections for the European Parliament are taking place in 2 weeks. And new commission will then be at the start, and we will see how things will just evolve over the time. What we've been seeing recently was the CSDDD, which just came more or less, across the finishing line. We have the CBAM regulation, about the cross-border adjustment mechanism for carbon neutrality purposes. We have deforestation regulation coming to force, and the forced labor regulations underway. We see for banks, CRD, CRR revisions under the Basel package, which has been approved finally by the EU institutions. The EBA, the ECB, they are quite bold in terms of climate risks in particular. We see similar things for insurance under Solvency II revision. And then we face more greenwashing related activities by the authorities. We wait for the ESAs to provide final reports thereon. We have seen the empowering consumers for the Green Transition Directive. The Green Claims Directive is underway. And finally, what will become, I think, the next big thing, and is about to become it because it's included to a certain extent in the regulating acts I mentioned just before, transition plan. And just going out here and saying thank you very much with a citation from Frank Alderson, a senior officer from the ECB banking supervision, who has said, failing to plan is planning to fail. So watch this space, be prepared, and thank you very much.
Good morning, everyone. Welcome to this special fireside chat on regulation and fintech. We have a very special guest, Josy Soussan, with us this morning. Josy, welcome and good morning.
Good morning, Alex. Good morning, everyone. Maybe quickly introducing myself. My name is Josy Soussan. I head up the European Policy and Government Relations at Klarna. We're an AI-powered global payments network and shopping assistant. But I'm also here today with my second hat as a board member of EFA, which is the European FinTech Association, which represents about 40 leading European fintech companies ranging from payments and lending, banking, robo-advice, ID verification, investment, as well as software as a service, supporting European citizens and businesses.
Awesome. So you are a very busy guy. So Josy, let's jump directly into the subject, regulation. Everybody talks about regulation. Everybody's saying that Europe is the most regulated territory in the world. But does it really benefit innovation? Does it really benefit fintechs? What's your point of view on regulation? And can you give us some insight about the benefits that Klarna, for instance, have benefited out of it, please?
I think that it's a very valid question. I think when you think about it from a fintech perspective, what is important to grow? It's important to have a regulatory landscape that allows for innovation, that ensures that rules are as harmonized as possible, because it allows you to scale up cross-border, to get a broad access to the markets, all while managing compliance costs. And I think we've seen a lot of regulation coming out of Europe that definitely helped the fintech community to grow and expand. And I think the most noticeable legislative pieces that we've seen were in the payment space. So we've seen, for example, PSD2, the Payment Service Directive, that really enables fintechs to grow through open banking and offer new payment services and products. We've seen very recently the adopted EID verification rules that enable fintechs to expand their offering quicker to other markets. Also, instant payments regulation that was recently concluded in Europe that really help fintech firms to directly access dedicated payment systems and payment rails. For us, for example, at Klarna, as a global payments provider, this is something we definitely benefit from as well. But more importantly, our European consumers benefit from, because they got access to safer and faster payment methods. I think another thing that's been very interesting and really helped the community in Europe is we've seen development of what we call harmonized regimes. So this idea that you're able to passport a banking license or a payment service provider license across the entire union, which is definitely a game changer for a business that wants to operate cross-border and across the union.
So regulation is a benefit. It's an advantage more than a challenge. That's your perception, at least. As a fintech, it's interesting because as an entrepreneur, you want less regulation so you can do more stuff and faster, but you have a different opinion on it.
Well, I think regulation needs to make sense. It needs to make sense to the consumers. It needs to make sense to the businesses. It needs to be applied proportionately as well, so that it doesn't completely disadvantage, large companies versus maybe the more innovative firms that want to come to the market. But it definitely also breaks down barriers and allows new companies to enter a market that they were previously barred from.
And there is a few regulation coming up, Josy, like FIDA, so financial data access. What's your point of view on that? Is it going to be beneficial? Is it there? What are the challenges regarding that new regulation?
Well, I think there are many exciting regulatory files coming out of Brussels on payments, as we said, on artificial intelligence, on digital finance, and on many more other issues. But I think, as you mentioned, FIDA is definitely a huge opportunities for the financial services sector. As a consumer, I think we've all seen the benefits of easily switching from your telecom provider, from your energy provider to an option that fits you better, that is less costly. But it's always been the question, why is it that complicated to switch providers in financial services or in banking? Maybe just one number. Only 18% of EU consumers have switched their banking provider in the last 5 years. So it's a very low number if you compare it to other jurisdictions. So why is that? And I think the primary purpose of FIDA is really to go from open banking to open finance. So really opening up not only the payments, but also other financial data to licensed third parties. It means increased consumer mobility. It leads to further innovation, stronger competition in the market, and eventually it brings prices down for everyone, including for the consumers. And I think that's what we're trying to achieve. So to give you a few examples of what FIDA actually means for consumers and for businesses. For consumers, it, for example, will help them, compare product features, prices, find more cost-effective options. It will also help them access more information, for example, on their payments or spending habits to manage their spending. but also their investment and their pensions, which is especially important, I think, in an environment like this where we have high levels of inflation. It will help them as well better access and control their data, which is something which is super important as well for consumers. If you move on the business side, I think FIDA will provide lots of opportunities for businesses, especially for SMEs. Simplify complex financial information and get real-time visibility in the health of their own business, for example, for managing their business. It will help them combat fraud more effectively by leveraging large data pools, which is something that is super important for corporates. Businesses that issue credit or insurances will help also through FIDA, will help strengthen their lending models and just get a better measurement of the risk profile. So I think these are just a few examples of what FIDA can bring, but I think the overarching benefit will be that it will bring more trust as well to financial services in the same way that opening up and switching in other sectors have brought in the past.
But that's a very utopic view of the future, which is great. It's exciting, as you said, but that also implies that the banks will have their role to play, and they will play the role. So what's your point of view on the collaboration between banks and fintechs? Are we there yet?
I think we're definitely way further than we were a couple of years ago. I think that PSD2, so the Payment Service Directive 2 that came in a few years back, really opened up the payment side of things, and we saw a lot of collaboration between banks and fintech companies, both through just direct collaboration. Sometimes fintechs were also more integrated into traditional banking systems. And I think that if we move from open banking to open finance, we'll see more of these types of partnerships and investments going from traditional players into fintech companies.
Thank you. FIDA is not yet implemented, is not even finished yet. What are the challenges you foreseen, and what do we need for FIDA to be successful?
Yeah, so as you said, Alex, it's not done yet. Actually, we're almost, we could say, at the beginning. So the text was proposed by the European Commission in June 2023, so almost a year ago, but it's still very much being negotiated. The European Parliament concluded their negotiating position in April last month, but the Council still has to come to a final position, and then we need to have what we call so-called trilogue negotiations. I think, if done right, again, the open finance framework can really be a catalyst for further competition, development of new financial services. And what we think at EFA is that it should be an open data economy that's multilateral and cross-sectoral. So to get there, I think there are a few things. We need fair access to data. It needs to be in full respect of data privacy, and it needs to ensure a level playing field between the incumbents and the fintechs. So on access to data, it basically means that all financial firms holding customer data should allow access to the data if it's requested by the customer, and it should be provided in real time, because that's the real benefit. That data obviously should be shared and open up only in full respect of the GDPR rules, the privacy rules. So it's really up to the consumers to be able to see where their data is, understand who has access to that data, but also keep the power to very easily revoke the consent at any time if they don't wish to provide that data anymore. And we need to have a level playing field. So we think at the EFA that it should be same activity, same risk, same rules, meaning that when we get to implementing the rules, the holders of customer data should be subject to very similar obligations so that everyone is playing the game in the same way.
And you think it can be Europe-wise, can be deployed? You don't see any difference between regions?
There will certainly be some cultural and some market dynamic differences, but I think the ambition of the Commission is really to have a harmonized approach to open finance. However, as I said, there's still a lot to be discussed. I think there are discussions as well to attacking this through what they call a staggered approach or a layered approach. So not opening up everything at the same time, but really taking it step by step, industry by industry. But I think eventually what we're looking from both on the legislative side, but also on the industry side, is that it's across the union and easier for fintechs and bank and other providers alike to really offer the same services across the single market.
Thank you, Josy. More a question for the fintech guy. What do you see the challenges for fintechs in Europe today, beyond the regulation? What are the challenges that you foreseen, or that you see, and what can we do about it?
I think it's more what can we do about it. I think we're at a very critical and exciting time, which is we have European elections coming up in less than a month. We're going to have a new European Parliament. We're going to have a new Commission with a new mandate. So we really have an opportunity here to shape the coming 5 years. I think there's one thing from our experience that won't stop changing, which is the continuous change in consumer behavior and really the rising adoption of fintechs by consumers. We've seen it in recent years. Fintechs are really contributing to the economic growth in Europe. They're driving productivity, they're creating jobs, fostering innovation, and really, I think, ensuring the resilience of the European financial system in a world that's becoming more and more and more digitized. But we can obviously do more because there are still a lot of obstacles, a lot of hurdles, a lot of fragmented markets. So what can we do to improve that? I think we need more support for innovative firms to become European champions. I think it's also a very important topic in the context of European sovereignty. So to have these European champions that really grow and innovate and again, help the European market. Therefore, we need to make it easier for consumers, for retail investors to access financial markets and for them to be accessing retail investment, make it easier to invest in European businesses. We need to fix on the payment side that fragmented landscape of payments. Even though we want it to be harmonized, it's still very fragmented sometimes. And I think we need some more interoperability between the national payment schemes. And also something that although it's prohibited by law, still exists today is IBAN discrimination. So the fact that depending on which market you are, they're not all IBANs are being accepted. So I think really limits pan-European payment solution to develop across Europe. So that's something we need to tackle. So we're looking at the elections. Maybe one word also from how we're viewing it very practically from a Klarna perspective. We are born and raised in Europe. Actually, 1 in 4 European voters is a Klarna customer. So we take Europe very, very seriously and very much at heart. That's why we launched the EU Pink Deal, which is basically our vision for the future of Europe. And it's very much focused exactly on what you said, on digitalization of financial services, on AI, artificial intelligence. That's also going to be a game changer for financial services. But to make it a reality, we need a healthy regulatory framework. We need fearless entrepreneurs ready to shake things up. And I think they're there. We just need a nudge on the policy making front. And we have a very good ingredients for a very good cocktail for the next coming 5 years in Europe.
Thank you so much, Josy. I want to ask you one projection for the future. What would be?
One projection for the future is we have a single market, we have a trade union, let's also have a payments union, have a savings and investment union. So really looking for harmonized rules to make it easier for new entrants in the financial services sector to really be able to offer the same services across the European Union, to scale up and to be really an alternative or a complement or a supplement to the existing offers for European consumers.
Awesome. If I'm a fintech, I want to join your association, what should I do?
Definitely check us out on social media or on our website, eufintechs.com. We're the European Fintech Association. Get in touch. We're more than happy to speak to you and come and join the forces, because every fintech has something very important to add to the discussions. And being the voice of fintechs in Brussels, we're more than happy to represent that voice as well. Awesome.
Thank you so much, Josy. Thank you so much for this fascinating insight on regulation, but also fintech and technology. Thank you, man. Benoit, I leave you the floor for the last remarks. Thank you.
Ladies and gentlemen, as we conclude our event, I want to thank our distinguished speakers and all of you for participating. We began with Alexandra Jour-Schroeder, who highlighted the latest development in European financial policy. She discussed the importance of unifying regulatory standards with the single rulebook and fostering supervisory convergence. We understand that the EU faces the challenge of balancing long-term goals with immediate needs, enhancing competitiveness and easing regulatory burdens. Guilbert discussed the capital market unions and the shift towards private markets to diversify funding and support of SMEs. Despite challenges like fragmented market and regulatory disparities, her perspective on building a more integrated and resilient financial ecosystem was enlightening. For his part, Dr. Stanislaw Tosza explained the dynamic changes in the EU anti-money laundering framework. The creation of the new EU-wide AML authority, the AMLA, along with the upcoming EU AML single rulebook, marks a significant step towards a more secure and transparent financial environment. Dr. Markus Lange took us through the evolving landscape of sustainable investment. He namely explained the Sustainable Finance Disclosure Regulation, the SFDR, and the EU taxonomy, which are pivotal to the EU sustainable investment strategy. Markus highlighted the effort to balance detailed regulation with practical application, aiming to prevent greenwashing and provide clear guidelines for sustainable activities. Finally, Josy Soussan shared the development in digital finance, from the early days of e-money oversight to the future with PSD3 and the Framework for Financial Data Access, FIDA. His insight into the EU's commitment to a secure, innovative and transparent financial environment were a fitting conclusion to our discussion. I hope today's session has provided you with valuable insight and a deeper understanding of the EU regulatory landscape. Thank you for joining us and have a wonderful day.